In this video, I'm going to tell you why investing in Alibaba will destroy your portfolio and the mistakes you should want to avoid at all costs. Alibaba is one of the largest e-commerce companies in the world with a market capitalization of over $500 billion. However, despite its impressive size and growth, there are many reasons why you might want to think twice before investing in this company. I will let you know about so many investors that have regretted buying into Alibaba and why you should avoid making the same mistake. The Lure of Alibaba. Once upon a time, Alibaba was the darling of the stock market. With its innovative approach to online retail, it was the shining star of the tech world and a symbol of China's unstoppable rise to global dominance. Its founder, Jack Ma, was hailed as a visionary entrepreneur who had cracked the code to success in the digital age. But oh, how the mighty have fallen. In 2023, the reality is very different. Alibaba's growth has stagnated, and the company is facing mounting legal and regulatory challenges that threaten to derail its future. The Alibaba Nightmare. Investors who plunged their hard-earned money into Alibaba are now living a nightmare. It's a ticking time bomb waiting to explode. The once mighty Alibaba has been facing a series of daunting challenges that have caused the stock to stagnate and investors' confidence to wane. From regulatory hurdles to slow growth and corporate government concerns, the future of the Chinese tech giant appears uncertain. Let's dive into the reasons why investing in Alibaba might be a risky proposition. SEC compliance and political risks. One of the biggest risks for investors in Alibaba is the company's struggle to comply with the US Securities and Exchange Commission's requirements to provide access to financial audit records. This has resulted in the company being placed on a watch list for delisting from US exchanges, a move that will undermine investors' confidence. Adding to this, the Chinese government has also been cracking down on Alibaba with fines for antitrust violations and blocking of Ant Group's IPO, which Alibaba owns a significant stake in. These political risks will further damage Alibaba's reputation, making it a very risky investment. Slow growth in key business segments. Alibaba's growth in key business segments such as China commerce has been slow and below market expectation. In contrast to American rival Amazon, Alibaba's core business segments have seen a decline in revenue year over year, while its cloud computing business grew its revenue by just 4%. This slower growth makes it harder for Alibaba to attract investors, especially given the political risks that the company is currently facing. Bear market and other investment opportunities. The bear market has been a challenging time for many companies, and Alibaba is no exception. As investors become increasingly risk-averse, they are looking for safe investment opportunities that offer stable returns. However, the ongoing challenges faced by Alibaba makes it difficult for the company to attract investors who are looking for security. One area that has emerged as a popular investment opportunity is the renewable energy sector. With increasing concerns about climate change, there is a growing demand for companies that are focused on sustainability. This has led to a surge in investment in renewable energy companies, which offers the potential for long-term growth and stability. In contrast, Alibaba is facing a range of challenges that makes its future uncertain. The company's slow growth in key business segments, combined with political risks, make it a risky investment proposition. As such, investors may be better off seeking out other opportunities in the market. In addition, the ongoing bear market has made it even more challenging for Alibaba to compete for investment. As the market declines, investors become increasingly risk-averse and they are less likely to take chances on companies that have uncertain futures. This puts Alibaba at a disadvantage as it struggles to compete with other companies that offer more stability and security. Increased competition. Alibaba is facing increased competition from other e-commerce giants like Amazon and Walmart. Despite its dominance in the Chinese e-commerce market, these competitors are making inroads into the country, with Amazon selling directly to the Chinese consumers through its global store and Walmart partnering with JD to increase its presence in the country. This competition could erode Alibaba's market share and affect its long-term prospects. Corporate governance concerns. The corporate governance concerns surrounding Alibaba have been increasingly worrisome. There are a number of factors contributing to these concerns, with one of the primary issues being the lack of transparency. This has been compounded by Alibaba's close ties to the Chinese government, which has raised questions about the level of control that the government may exert over the company's operation. Co-founder Jack Ma has been at the center of much of the criticism directed at Alibaba's corporate governance practices. Ma's close relationship with the Chinese government has raised concern about potential conflicts of interest, particularly given the company's status as one of China's largest tech giants. In addition, there have been questions raised about the level of influence that Ma wields with the company and the extent to which he may be able to make decisions that are not in the best interest of shareholders. Another area of concern is Alibaba's financial reporting practices. There have been questions raised about the accuracy and completeness of the company's financial statements, particularly with regards to its relationship with affiliate companies. The company has also been criticized for its lack of transparency around certain business practices, such as its use of data to drive sales and advertising. The combination of these factors have created a challenging environment for Alibaba, particularly when it comes to investors' confidence. Concerns about the company's corporate governance practices could further erode the confidence, particularly if investors begin to question the long-term viability of the company. This could ultimately impact the company's ability to attract new investors or retain existing ones, which could further hamper its growth prospects. In response to these concerns, Alibaba has taken some steps to improve. The company has announced plans to increase the number of independent directors on its board and has established a special committee to oversee compliance with regulatory requirements. However, it remains to be seen whether these measures will be enough to address the concerns of investors and restore confidence in the company's long-term prospects. Overall, the corporate governance concerns surrounding Alibaba are a major issue that could impact the company's growth and future success. As the company continues to navigate these challenges, it will be important for investors to closely monitor its progress and consider whether the risks associated with investing in Alibaba are worth the potential reward. Heavy reliance on e-commerce in China. Alibaba's heavy reliance on e-commerce in China has been a double-edged sword for the company. On one hand, it has allowed Alibaba to establish a dominant position in the Chinese market and generate significant revenue, but on the other hand, it also made the company more vulnerable to economic and regulatory shocks, such as changes in consumer behavior or government policies. Any disruption to the e-commerce market in China could have a significant impact on Alibaba's bottom line. To mitigate this risk, Alibaba has been making efforts to diversify its revenue stream. The company has been expanding its cloud computing business, which has been growing at a steady pace in recent years. Alibaba has also been investing in other companies, such as a Chinese logistics firm and the Southeast Asian e-commerce platform. These initiatives have helped Alibaba to expand its presence beyond e-commerce and reduce its reliance on a single revenue stream. But despite these efforts, e-commerce still remains Alibaba's primary source of income. This is reflected in the company's financial statements when the majority of the revenue comes from its China commerce retail business. While diversification is a positive step in the company, it will take time to establish new revenue streams and reduce Alibaba's dependence on e-commerce. The recent 20% increase in Alibaba's stock price may seem like a positive sign for investors, but it's important to approach this development with caution. However, the long list of risks and challenges facing Alibaba has not disappeared overnight. Investors should carefully consider these factors before making any investment decisions. In conclusion, don't let Alibaba's troubles keep you from investing. If you're still unsure where to put your money, check out our video on the best dividend stocks to invest in 2023.